Good afternoon. I'm Kelly Lee. For those of you who don't know me, I'm the managing partner with Strong Gaddy Lee Wealth Management Group. And I want to thank you all for joining us for the Strategic Guidance for Life educational series. These meetings are intended to continually educate our individual clients and retirement plan participants with the hope that it leads to better long-term financial decision making. Where possible, we provide presentations that help explain questions we are or have received and topics we feel help our investors be more successful. Today, we will review the first quarter's market update and economic outlook. I'm pleased to have with me SGL's Chief Investment Officer, Andrew Beatty. As our CIO, he provides our firm with economic and market insights as well as strategy. He and his team conduct in-depth research, monitor market trends, and assess risk factors to develop recommendations to our investment committee. Before joining, Andrew was a senior investment analyst with Wells Fargo Investment Institute, where he was responsible for investment strategy and manager selection. In addition, Andrew began his career as an institutional investment consultant with two of the leading global investment consulting firms, Cambridge Associates and Wilshire Associates, where he advised endowments, foundations, pension plans, and other institutions on investment decisions, asset allocation, and manager and strategy selection. Welcome, Andrew.
Thanks, Kelly. I'm glad to be here.
We're happy to hear what you have to say today.
Perfect. So we'll jump into it. I think obviously the first quarter was, to call it challenging, is probably a little bit of an understatement. It was incredibly volatile for investors, largely shaped by the beginning of the war in Iran. So I will share my screen so we can all follow along here. And let's keep going here. So perfect. So we're going to cover the first quarter and then look forward. So what dominated the first quarter was obviously the equity markets declined based on the war in Iran. The S&P 500 finished down roughly 4%, which is the weakest quarterly performance that we've seen since 2022. Markets really began the year, however, on pretty solid footing. We did see new highs reached in the S&P in January, but that really fell apart and the sentiment shifted dramatically following the onset of the U.S.-Israeli military action in Iran. Rising oil prices were a lot of the talk here. We'll discuss that later. That pushed inflation concerns back to the forefront and created a broad risk-off market. This weighed especially heavily on the large cap and large cap growth stocks, as you see here on the chart. The large cap stocks in growth, the Russell 1000 growth as the proxy there, was down almost 10% during the first quarter. If we go beneath the surface, though, market leadership broadly advanced in different portions of the market than we've seen towards the end of last year and the beginning of this year. And that's because small cap stocks, value stocks are really the ones that led the way. And this is a key thing here because one of the things we always want to focus on is diversification because we don't know when market performance is going to broaden out like we saw during the first quarter. So that's why we want to remain diversified within portfolios. In fixed income markets, fixed income also faced some headwinds, although not as strong as in the equity markets. Treasury yields moved higher globally, and that was across most of the curve. Investors really were repricing inflation expectations and the potential for Fed rate cuts as we move throughout the year. So as a result, we did see the broad Bloomberg aggregate bond index down very slightly. Longer duration assets and longer duration bonds underperformed, while mortgage-backed securities and shorter duration bonds actually outperformed during the period. So overall, we saw a volatile quarter. We saw overall a generally negative quarter, but the big story was the war in Iran and further the increase in oil prices. Like I said, obviously the story, so we've talked about, was the war in Iran. What we wanted to look at was how those previous conflicts affected the S&P. So we took S&P returns going back to the 1940s to see what was the average drawdown and what was the time it took for the market to get back to pre-conflict levels. And what you see here from this chart, with the exception of Pearl Harbor and World War II, the market has typically been very resilient during conflicts. In fact, most of the time, markets see only modest pullbacks, which is seen on the horizontal axis there, and the market has generally recovered to pre-conflict levels within fewer than 100 days. So we've already seen the S&P regain its footing. It is now back and beyond the levels that we saw prior to the war in Iran. And that's another example, beyond just diversification, that's another example about how we view volatility and why we view volatility frequently as an opportunity rather than a difficulty or a headwind for investors, especially investors that are taking a longer term view. Periods like this can pose a bit of an opportunity for us. We've discussed the war in Iran. Obviously, that has dominated the headlines. The other thing that's dominated headlines was the price of gas and oil. The defining portion of this is the closure of the Strait of Hormuz. That is a key choke point for global oil supply. It carries through about 20% of global oil supply. And so that is a significant impact on the broader oil markets, which are traded internationally, even though as we see here, we're looking at the two different oil prices. One is the US proxy, which is the West Texas Intermediate. The other is the Brent price, which is the global price. They're both priced in dollars, however, so we're not worrying about some sort of petrodollar falling there. When we look at this, what we saw was immediately after the Strait of Hormuz was closed, prices for both of these benchmarks advanced and really rocketed up past $100. Now, that has been tempered recently. As of this morning, WTI was trading about $95. But what we're seeing is that that is permeating through other parts of the market. As we'll talk about a little bit later, oil is a significant input for vast sectors, vast industries. The other thing is that a lot of other commodities come through the Strait of Hormuz, things like natural gas, fertilizer, even helium. A lot of that transports through the strait. So as long as the strait is closed, and there is an additional blockade from the US right now, what we're expecting is elevated oil prices going forward. Now, that doesn't mean it's going to always be above $100, but it's going to be elevated compared to where it was before the war began. Now, we want to stay on that for just a minute because one of the big inputs there, obviously, we talked about oil being an input to other sectors, other industries. So the impact, if we do see higher prices there, is likely to be on inflation. And that was one of the concerns that we saw during the war and during that pullback, is that investors were worried that inflation was going to increase. You know, as we entered the year, the expectation was that inflation was going to continue to temper. It was going to effectively remove any hesitancy from the Fed, and the Fed would be able to act by cutting rates. After we see oil prices go up, again, that's a direct input and probably going to increase prices and increase inflation. What we're going to expect to see now is that the Fed is going to be precluded from acting for some time. Now, we still expect to see a couple of rate cuts this year, but instead of seeing one probably beginning or midway through the summer, now we're looking at potentially September as being the first time that the Fed would maybe act. So as we're doing this and as we're thinking about, one of the things we thought at the beginning of the year was that Fed rate cuts would be a tailwind for equities. Has that changed our opinion? And the answer is it actually hasn't. And the reason that we think equities are poised to continue their advance is what you see on this page. And that's the fundamentals of the market, and specifically the earnings growth within the market. We've charted here the earnings growth expectations and realized earnings growth for the S&P going back to 2023. And what we're expecting for the first quarter reporting season that we're going through right now is to see somewhere between a 12 and 13% increase. Now, we've had about one quarter of the S&P report so far, and what we've seen is that most of those estimates are actually low. We're seeing 14, 15, 16% expected earnings growth as we move through the different sectors that are reporting. So this does, and something to keep in mind here, these earnings do incorporate the effects of the war in Iran into them. So we're not seeing the war in Iran be a big impediment to corporate earnings. And so that is what we're expecting from a fundamental basis. So now, what do we see in terms of earnings and how that impacts equities? So again, we like to look back over history and let history be our guide here. And one of the things that we looked at here was, what did the S&P do when there was double-digit earnings growth over a year? Which, again, going back to the last slide, we expect to continue going forward? And the answer is that with the exception of 2000, which was the dot-com crisis, and 2018, every time the S&P 500 has posted double-digit earnings growth during a year, again, that's what we're expecting here, the market has advanced. And that advance, as you see on the chart, is frequently more than 10% during that year. So strong earnings quality and earnings growth has historically proven to be a pretty significant tailwind to equities. Again, we think that's going to continue. And then just to drive this point home one more time, because I know that I'm a visual learner, so I want to see as many visuals as possible. We wanted to chart the growth of the S&P 500, which is on the left axis, and then earnings per share for the same index, and that's on the right axis. And what you can see is as earnings adjust and as earnings go up and down, so does the S&P. They are highly correlated. So if we're expecting earnings to continue to advance, continue to grow, which we do, we should expect to see a similar increase in the S&P 500 overall. So let's stop there for a second, but let's take a look forward to what we're expecting for the rest of the year. And what we're expecting from an economic standpoint is, look, there are going to be some difficulties in the marketplace. We are expecting a slower labor economy. We're expecting a little bit of inflation. We're expecting some continued uncertainty around trade policy and ongoing, obviously, geopolitical entanglements as we've seen in Iran. But we do expect the underlying strength in the U.S. economy to be strong. We continue to see the U.S. economy supporting growth. And like we expect, or like we discussed earlier, we do expect, despite the inflationary pressures, to see the Fed act to cut rates towards the end of this year. Probably two rate cuts, both of about 25 basis points is our expectation right now. That should also provide a little bit of a growth tailwind for the economy. In the stock market, as we discussed, the backdrop for equities is incredibly constructive right now, specifically in the US. There are a couple of factors to focus on. Obviously, the earnings that we talked about. The other thing is we continue to see companies investing in the AI build out, and that continued investment is going to continue to push equities further. We've talked about that being a tailwind. We think it will continue. The other thing is that as we saw equities fall during the Iranian conflict, that actually made valuations for those companies more attractive. So from a valuation standpoint, from a fundamental basis, equities in the US are very attractive at this point. In fixed income, it's a little bit of a different story. We do see and we have seen the market dominated by rising global yields, excuse me. As we've discussed, shifting Fed expectations throughout the year, and then also this overlying pressure from private credit concerns, which has been dominating the headlines of late, but is really somewhat segregated from the rest of the credit market that's the public credit market, so the traditional fixed income and bonds that we think of. We do think, and we thought this at the beginning of the year, that there would be some volatility, but that ultimately Treasury yields would be somewhat range bound. And so we think that's going to continue as we go into the second half of this year. So then what we'll see is the returns in fixed income will largely come from the income derived from those securities rather than any sort of capital appreciation that we may see. So overall, we have a pretty optimistic view of the markets going forward, both economically within the stocks and in the bond market. So I think that while we've seen volatility, and I think as an investment committee, what we've discussed is when we see those periods of volatility, since we do have a longer term view of markets, that's probably an opportunity for us to buy very high quality assets that are currently on sale. And that's what we've been doing and discussing during the investment committee meetings. So with that, Kelly, I will hand it back over to you.
Perfect. Thank you, Andrew. Really appreciate it. Look forward to seeing what the second half of the year brings. I hope you all enjoyed today's information, found it helpful. Be sure to mark your calendars for next month where we'll be doing a presentation about behavioral finance, which I always think is interesting. People's behavior around investing in the markets is always fascinating to me. So John Hancock will be joining us for that presentation. As always, if y'all need anything, just give us a call or let us know at the office, and we're happy to help. Thank y'all. Have a great weekend.